If you watched my last video on Melbourne, you know the situation. The Iran war has sent fuel prices to record highs. The RBA has hiked rates to 4.1%. SQM has slashed forecast across the board. Investors are nervous and many are sitting on the sidelines. But here's what most people don't realize. Not every market reacts the same way. And Tasmania, which was already one of Australia's most affordable states, is actually better insulated from some of these shocks than the mainland capitals. Today, I'm going to show you why Tasmania's affordable suburbs still make sense as investments right now, even in the middle of a global energy crisis. And I've got 3 specific suburbs, all under 700,000, all delivering yields above 4% that I think deserve your attention. Let's go. Before we dive in, if you're new to the channel, I'm Sean and I run PropSpotter. We're a property research advisory built on 3 pillars: research, source, and coach. What that means in practice is this: we use over 30 institutional grade data sources to identify the right suburbs for your property investing strategy. Then our proprietary listing system monitors those suburbs like a hawk 24/7 and alerts you the moment a new property goes live, before most investors have even opened domain or real estate that morning. And then we coach you through every step from evaluation to settlement via a dedicated one-on-one group. It's everything a buyer's agent provides: the research, the sourcing, the guidance, except you keep the skills, you stay in control of every decision, and it costs a fraction of the price. We've coached over 50 investors across Australia with a perfect 5-star rating on Google. If you want to learn more, the link to book a free strategy call is in the description. Now let's get into the data. For those who haven't seen my Melbourne video, here's the quick version. The US and Israel launched strikes against Iran on February 28. The conflict has effectively closed the Strait of Hormuz, the shipping lane through which 20% of the world's oil flows. Brent crude surged 59% in March. The Australian government is halving the fuel excise from tomorrow, the 1st of April, a $2.5 billion emergency measure, because petrol has hit $2.50 a litre and diesel is well above $3. The RBA has hiked the cash rate twice this year to 4.1%, citing energy-driven inflation risk. Rate cuts that were expected for mid-2026 are now off the table entirely. Borrowing capacity has been squeezed. Property forecasts have been revised downward. And this is the critical point: the war doesn't change the structural forces that drive property over the medium to long term. People still need somewhere to live. Net migration into Australia is still positive, housing supply is still constrained, and rental markets are still tight. And Tasmania in particular has some unique characteristics that make it worth your attention right now. Let me explain why Tasmania sits in a different position to the mainland capitals during a fuel and inflation shock. First, affordability. Tasmania's median house price is around $620,000. Compare that to Sydney at over 1.7 million, Melbourne approaching 970, Brisbane above $1 million. When borrowing capacity gets crushed by rate hikes, Tasmania is one of the few places where median income households can still actually afford to buy. That floor of demand doesn't disappear in a crisis, it actually concentrates. Second, yield. Tasmania offers some of the highest rental yields in Australia. The suburbs I'm about to show you are delivering 4 to 5% in gross yields. In a high rate environment where cash flow is king, that matters enormously. A property that covers its holding costs gives you time to ride out the volatility without financial stress. Third, the rental market is extremely tight. Hobart's vacancy rate is around 0.6%, making it Australia's second tightest capital city rental market. Launceston is even tighter at roughly 0.5%. Even if property values soften slightly, your rental income is protected by structural undersupply. Total listings in Tasmania has dropped 21% year on year. There simply is not enough stock. And fourth, Victoria and Tasmania both have announced free transport to ease the fuel crisis. If you're an investor with a property near a bus or train route in Hobart, your tenant's commuting costs just went to zero. That's a direct quality of life improvement that makes your rental property more attractive, not less, during a fuel crisis. The other thing I want to emphasize is Tasmania's massive infrastructure pipeline doesn't stop because of a war in the Middle East. These are funded, contracted projects that are being built right now. The Bridgewater Bridge, $786 million, Tasmania's biggest ever transport project, opened in mid-2025 and is already transforming commute times for Hobart's northern suburbs. The Macquarie Point Stadium, $1.13 billion, approved by Parliament in December 2025 and is now in the contractor procurement phase. The Tasmanian Devils entered the AFL in 2028. this is happening. The Tasman Bridge upgrade, $130 million, starts construction this year. The Northern Cities Major Development Initiative is bringing government investment into Launceston, Devonport, and Burnie. And the energy sector, well, that's pumping billions of dollars into projects like Marinus Link and the Robben Islands wind farm. All of these projects create jobs in a small economy like Tasmania. Construction jobs have an outsized impact on local spending and the housing demand. The infrastructure spend is the closest thing you get to a guaranteed demand driver, regardless of what's happening in global oil markets. Talking about suburbs now. Claremont sits on the Derwent River about 12 k's north of the Hobart CBD. Typical house price of $613,000 with median rents at $500 and a gross yield of 4.2%. That's comfortably under the $700,000 bracket and delivering strong cash flow. Claremont is an established suburb with over 4,350 dwellings and 8,400 adults living there. It has a major Claremont Village shopping centre, precinct, schools, medical facilities, and all the 20-minute neighbourhood fundamentals. What makes Claremont particularly interesting right now is its position relative to the Bridgewater Bridge. The new bridge has dramatically improved the corridor between Hobart's northern suburbs and the CBD. Claremont sits right on this improved route, benefiting from both the direct bridge improvement on one side and the spillover demand from suburbs further north like Bridgewater and Brighton, where prices are even more affordable. With 153 annual sales, the market is liquid enough for investors, and the 130 annual rentals show a healthy, active tenant pool. At 4.2% yield with the RBA cash rate at 4.1%, a well-purchased property in Claremont is close to cash flow neutral from day one, which in this environment is an incredibly strong position to be in. The next suburb is Bridgewater. Bridgewater is the most affordable suburb on this list and frankly, one of the most affordable suburbs near a state capital in Australia. Typical house price of under $494,000 with weekly rents of $440 and a gross yield of 4.6%. Now let me be upfront, Bridgewater has historically been one of Hobart's more affordable and lower socio-economic suburbs. There are legitimate reasons why it's priced where it is, but here's what's changed. The $786 million Bridgewater Bridge, which opened in mid-2025, has fundamentally transformed this suburb's connectivity. Previously, the old bridge was a narrow, congested bottleneck that made commuting to Hobart a genuine deterrent. The new 4-lane bridge has eliminated that problem. Property analysts specifically flagged the northern suburbs of Hobart, including Bridgewater, as areas likely to attract stronger growth and investment in 2026 because of the bridge completion. When you improve transport connectivity to an affordable suburb, you open it up to a wider buyer pool. That's the mechanism that drives price appreciation. At $494,000, this is deeply accessible. It's well under the first home buyer cap. The yield at 4.6% is the strongest on this list, and with about 2,325 dwellings and 43 annual sales, it's a small but active market. For investors who prioritize cash flow and are willing to hold through a gentrification trajectory, Bridgewater is a compelling play. The risk? It's a lower income suburb, which means tenants are more vulnerable to cost of living pressure. In a fuel crisis, that's a real consideration, but the free public transport announcement in Tasmania offsets some of this, and the underlying yield means you have buffer even if you experience slightly higher vacancy periods. Next up, Glenorchy. Glenorchy is the surprise packet, a typical house price of $615,000 with a gross yield of 4.8%. That's nearly 5% yield in a suburb that's only 8 k's from Hobart CBD. Weekly rents are at $572, which is the highest of the three suburbs, reflecting the quality of the tenant pool and the suburb's proximity to employment centres. Glenorchy is the administrative centre of the Glenorchy City Council, which means it has significant community infrastructure, council offices, community centres, health services, and major retail, including the Northgate Shopping Centre. It has a population of over 12,000 adults across 6,000 dwellings. This is a genuine suburban hub, not a dormant suburb. 170 sales, 169 rentals indicate a balanced market with strong liquidity. Investors can get in and out of this market without difficulty, and the consistent rental demand means vacancy risk is low. Glenorchy also benefits from the broader Hobart Northern Corridor improvement. The suburb sits between the CBD and the Bridgewater Bridge corridor, meaning it captures demand from both directions. People priced out of inner Hobart looking north, and people who from further north who want to be closer to the city. At a yield of 4.8%, this is the kind of property that can genuinely service its own mortgage in the current rate environment. If you can find a property at the lower end of the price range, say $550 to $600, with rent at $550 plus per week, you're looking at a holding cost that's either neutral or slightly positive. That's rare in Australian capital cities right now. I wouldn't be doing my job if I didn't cover the risk. And Tasmania has some specific ones that are amplified in the current environment. Population growth is weak. Tasmania is growing at 0.2% versus 1.6% nationally. Net interstate migration is negative. If the war-driven economic slowdown reduces immigration further, Tasmania's small population base makes it more vulnerable than larger markets. Secondly, the economy is narrow. Tourism, agriculture, and government are the three pillars. A prolonged fuel crisis could impact tourism significantly. Fewer interstate visitors, more expensive flights, higher costs for tour operators. That will flow through to local employment and housing demand. And the war itself creates uncertainty that could delay investment decisions. The Macquarie Point Stadium, for example, depends on contractor costs staying manageable. If building materials and fuel costs spike further, there's a risk of cost blowouts and timeline delays. And this is important. The yield protection in these suburbs means you can absorb some softening without financial stress. A property yielding 4.6% in Bridgewater doesn't need capital growth to justify itself in the short term. It pays for itself. And that's the fundamental difference between investing in affordable, high yield markets versus stretched, speculative ones. Here's the bottom line, ladies and gentlemen. The Iran war and fuel crisis have created real economic headwinds, but Tasmania's combination of deep affordability, strong yields, tight rental markets, and funded infrastructure makes it one of the better insulated markets in the country right now. The three suburbs I'd be researching are Claremont at 613 with a 4.2% yield, Bridgewater at 494 with a 4.6% yield, and Glenorchy at 615k delivering nearly 5%. All under 700,000, all with yields that can service a mortgage in current rates. All in suburbs with real infrastructure improvements underway or recently completed. And if you want this kind of analysis personalized to your own strategy, your budget, your risk profile, your target markets, well, that's exactly what the PropSpotter system is built for. We do the institutional grade research, our sourcing engine finds the properties, and we coach you through every step. The link to book a free strategy call is in the description below. If you found this series useful, the Melbourne video and this one, make sure you subscribe. I'm putting out data-driven analysis every week on where the actual opportunities are, not where the headlines say they are. See you in the next video.